Hello and welcome to today's web seminar, another installment of the educational web seminar series presented by Interstate Motor Carriers Capacity Agency LLC. Today we'll be discussing a reclassification update focused on New York, New Jersey, and Connecticut regulations, including recent legislative efforts and audit processes, with special guest speaker John Kellenberger, Esquire. John is an attorney who specializes in transportation-related issues. Before we begin, a little bit about the technology we'll be using today. All of your lines have been muted for the duration of the web seminar. You can enter any inquiries that you have at any time throughout the presentation through the question box or chat box, and we'll queue them up for a Q&A session at the conclusion of the web seminar. You can also slide the GoToWebinar box closed by clicking the orange arrow or double arrow, but do not click the black X or you will exit the web seminar. Now, without further ado, please welcome John Kellenberger.
Good afternoon, everybody, and thanks for taking the time to join us on the webinar. As John mentioned, I am a transportation attorney, and a large part of my practice involves representing motor carriers before state departments of labor and the federal government in reclassification efforts. So just wanted to start today with a little bit of a summary of what reclassification is. So essentially what reclassification is, what we're talking about is a scenario where you, as the motor carrier, have designated your owner-operators as independent contractors. You're treating them as 1099 contractors. You're not withholding any taxes. You and the owner-operator are fine with that agreement. You have a lease agreement that says that. And then all of a sudden the state or the federal government comes in and says, well, actually, the owner-operator isn't independent. He's actually an employee under our law. And what makes this process even more difficult is the concept of dual sovereignty, that the Fed government can hold that the owner-operators are independent contractors, and state governments may hold that the owner-operators are employees. So you could have a scenario where the IRS or the Federal Department of Labor is looking at your operation and saying your owner-operators are actually independent and you're doing things the right way, and then the applicable state government that's in charge of the jurisdiction in which you're operating says, well, actually, no, under our view, these folks are employees. What are the consequences of something like that? Well, you can have a scenario where, obviously, if you've been treating them as independent contractors, you're not withholding state unemployment tax because they're not, in your view, employees. So you can wind up with a very large assessment from the state DOL for unemployment contributions, interest, penalties, workers' compensation premiums. So if the workers' comp carrier now says these folks are employees and we have exposure there, you could wind up paying additional premium there. A lot of states also have misclassification statutes which impose criminal and or civil penalties on entities that misclassify folks. So significant amount of exposure, and it's a difficult field to manage because you have all these different levels of government using different tests. Next slide, please. What we've seen, there's been a tremendous surge of activity in the state governments in looking at this issue, and for the most part, in our industry, it's been negative in the sense that most state governments are now looking to reclassify a lot of owner-operators as employees. So a lot of states are looking at passing statutes that make it very difficult for your operation to meet the standards of having your owner-operators be independent contractors. Pretty good reason for that is a lot of the state unemployment funds are running very low, and this is kind of a money grab. It's an easy way for states to replenish those funds. In addition, you have significant interest from labor unions in looking at reclassifying the industry. So there's been a tremendous push, and we expect that to continue. In the last 4 months, New York, New Jersey, and Connecticut have all passed laws specifically targeting our industry. And we're expecting this momentum to continue throughout the country. So why don't we just take a look first at New Jersey. Next slide, please. In the unemployment context, New Jersey has a present statutory exemption, which if you meet the statutory exemption, your owner-operators are exempt from the state unemployment tax contribution. So it's a four-pronged test, and the difficult prong to meet is prong A, that the owner-operators are providing services which are exempt from FUTA. That used to be a very easy standard to meet under the New Jersey Department of Labor's regs. Typically, you could just go in and explain that in the past the IRS has looked at owner-operators and said that they are exempt from FUTA, and the DOL kind of accepted that. What's changed in the last year and a half is the way that the DOL looks at that prong. What they've been saying now is that you need some kind of IRS letter determination or a revenue ruling, so it's some formal correspondence from the IRS stating that you're exempt, that you've been involved in a previous unemployment audit where the IRS has looked at your business and said that your owner-operators are exempt, or quote other valid evidence that would establish to the Department of Labor's satisfaction that your folks are exempt. I've represented several motor carriers before the Department of Labor, and in certain cases I've actually had to go to the IRS and get a revenue ruling, and I've been successful in doing that. The problem is the expense to the IRS is very significant, and it's a time-consuming process. As you can see, for prong B, almost all the time you're going to meet that. Obviously, we're operating vehicles in excess of 18,000 pounds, licensed for commercial use. Must own the equipment, but one of the issues there is if you're running a lease-to-own program through an affiliated entity, you may unknowingly be knocking yourself out of the state exemption. And then D, it's compensation by receiving a percentage of gross revenue or schedule of payments based on distance and weight of the move. So those are the main issues in looking at that. Really are if you're running a lease-to-own program, or if you do wind up getting audited, is having something from the IRS that says that your folks are exempt. Next slide, please. In the drayage industry, the New Jersey very recently passed SB 1450. It was passed May 30th of 13. And it's going to go into law if the governor does not veto the bill by the time the Assembly comes back into session. Right now, we're hearing that the Assembly is not going to come back into session during the summer, although that is subject to change, based on the political winds. So for folks who are impacted by this bill, we would strongly recommend that you contact the governor's office and advocate for him to veto it. Because if he does not veto it by that time, it will become law. SB 1450 creates presumption of employment for all drayage drivers in the state of New Jersey. So it basically, that exemption that we just talked about is gone for the drayage folks. They are employees, and what that means is that in New Jersey, these folks are now subject to all of New Jersey employment regulations. So the New Jersey wage and hour laws, the unemployment tax contributions, workers' comp, all of those things are now in play for these folks, regardless of how you have contracted with them to be independent. The statute does give labor unions the ability to bring lawsuits against the motor carriers who don't classify properly. That's even if you don't have a relationship with the union. So in other words, you may not be a union shop. You may be treating your folks as independent contractors. Your owner-operators may say, we like that, we're fine with that. The union can bring a suit. They have standing under the statute to do that, to try and enforce it. Next slide, please. The statute also has civil and criminal penalties for misclassifications. So the civil penalties and the disorderly person convictions would be in a case where you're not doing it, quote, knowingly. So they don't have to, the state doesn't have to establish that you're knowingly misclassifying these folks. If you're doing it, you're subjecting yourself to penalties of $2,500 to $5,000 per driver per week, and a disorderly person's conviction, and then an additional $100 to $1,000 per driver per week. And then obviously, if you're committing it knowingly, you're subjecting yourself to felony conviction. Now, our sense is that the governor is still likely to veto this bill. We've been involved in a lobbying effort. I know the New Jersey Motor Truck Association has been involved and done a good job in lobbying against the bill. But just be aware that if the governor does not veto it, this will become law, and these are, basically there's a lot of teeth to this statute. So, folks operating the drayage industry really, really need to pay attention to this. Next slide, please. On the workers' comp side, New Jersey has two tests. They basically, for the most part, look at the relative nature of the work test. And what the courts have said is that what they're going to look at is the extent of the economic dependence of the worker upon the business he serves. And what that means and what the DOL looks at is the work must be sporadic, not permanent work, and it must be incidental and not a principal part of the motor carrier's business. What this means for you is it's a very, very difficult standard to meet. Most of the time, the economic dependence between your owner-operators and the motor carrier is going to be one of you're going to be providing all the revenue that owner-operator receives over a given period of time. The important thing to bring up in the defense of any reclassification is that the owner-operator, if you allow trip leasing, the owner-operator can trip lease. If he or she does trip lease, you want to keep a record of that. And also, the fact that the owner-operator is free to leave. If you have leases that provide for them to leave without penalty, and with the current climate of the driver shortage, these are factors that you bring up. But it is a very difficult test to meet. Next slide. The other test that New Jersey workers' comp will look at is the right of control test. So does the motor carrier determine the daily details of the owner-operator's duties? So what we're talking about here is, can you control not only the results that are to be obtained, in other words, the load has to be delivered on Tuesday by 4 o'clock, but do you have the right to control the manner in which the owner-operator is providing that services? And the factors that are often looked at by the courts and the DOL is, what are the terms of dispatch? Do your owner-operators have to accept loads that you give? Are there penalties if they don't? Are the deadlines imposed by the motor carrier or the customer? It's just the way that you phrase the instruction. So, the customer has a requirement that the load is there by 5 o'clock on a Wednesday. And you want to also have your owner-operator leases reflect this fact that, the requirements that you give to the owner-operator are, A, either required by federal or state regulation or law, or B, are customer requirements. Who owns the equipment? Well, in most cases, the owner-operator is going to own or lease the equipment. Do they have to report in a certain time? Are there appearance standards? Do they have to wear a uniform? Can they hire and fire their own helpers and workers? So as long as the folks who are going to help them, whether it be drivers or drivers' helpers, are qualified under the DOT standards, do you have the right then to step in as the motor carrier and say, no, we don't like Johnny, we don't want him to be a driver in your fleet, for whatever reason? If there's not an insurance qualification or an actual qualification requirement there, you're going to have an issue with the right of control test. Next slide, please. New York, like New Jersey, was looking at reclassification bills this summer. The New York statute that was passed was a compromise between the New York Motor Truck, the ATA, Teamsters, the Couriers. A lot of interest groups got together and negotiated out a compromised bill, which is better than what was initially proposed. Obviously not ideal, but again, a significant job by the New York Motor Truck and folks who were going to Albany and lobbying on your industry's behalf. This law is in effect. It's on the governor's desk right now. The law provides two separate tests for motor carriers to meet to establish that owner-operators are independent. So if you can meet either one of these tests, your owner-operators are independent contractors and not employees under New York state law. Next slide, please. The two tests are, you have the ABC test and the separate business entity test. So the ABC test is a very difficult test for folks in your industry to meet. You have to show that the owner-operators meet all three of the prongs. You have to show that the individual is free from control and direction in performing the job under his or her contract. And in fact, so that kind of goes back to the right of control issues that we were just talking about in New Jersey, looking at the same factors that we discussed. You also want to make sure that your owner-operator leases are clear, as to any requirements that you're imposing upon them are required by the DOT or by the customer. They're not yours. If you're requiring folks to attend safety meetings, again, that's pursuant to DOT regs. That's not your requirements. B, the services must be performed outside the usual course of business for which the service is performed. Some courts have looked at the location of your business, so you're always going to be, the owner-operator is always going to be performing outside of your facility. And C, the individual is customarily engaged in an independently established trade, occupation, profession that is similar to the service at issue. So what we're talking about here is you want to make sure that the auditor understands that the entity that is the owner-operator. So if you have an LLC, John Kellenberger Trucking LLC, who is leased on to XYZ Motor Carrier, that business is going to go on if XYZ Motor Carrier terminates the relationship. In other words, me as the owner-operator, I can go lease on to ABC Trucking the next day, and I'll continue to have work. I'll continue to have a business. It's a very difficult test to meet, the ABC test, and the reasons why is the New York DOL will frequently hold that the owner-operators are in fact not free from control or direction. They're not engaged in an independently established trade. The DOL will frequently say that once the relationship between the MC and the owner-operator terminates, the owner-operator's business is done. And the other thing is they frequently note, and quite rightly a lot of times, that all the revenue received from the owner-operator in a given year is received from the motor carrier. So they'll say that that there is no independence. It's not an independently established trade because it's completely dependent upon the motor carrier. Next slide, please. The second test that New York now has is the separate business entity test. You must meet all of the following criteria, and as you'll see from the slides, the list is going to go on and on and on. But this was the compromise that was worked out between the New York Motor Truck, the Teamsters, and several other interest groups. And as you'll see, it is still very plausible for a motor carrier to meet these tests, and for an owner-operator to establish their separate business entities. So, first criteria, business entity performing the service must be free from the direction or control over the means or manner of providing the service, subject only to the right of the commercial goods transportation contractor to specify the desired result or federal rule or regulation. So again, this is what we've talked about before. The idea is that you're not controlling their means of operating. You're not telling them which route to take. You're not giving them direction over how they're going to perform the service. But however, the legislation does recognize that there are certain federal rules or regulations that you must require them to follow, and that the customer is able to specify the result that they need. So the suggestion that we have as owner-operator leases must be clear that the owner-operator must satisfy the DOT regs, achieve the result that the customer wants, but on the other hand, the lease should be clear that the owner-operator has their own control over the means, the methods of achieving that. Next slide, please. So B and C, the business entity is not subject to cancellation or destruction upon severance of the relationship with the commercial goods transportation contractor. This is what I just talked about pointing out to the DOL auditor, if you're in that context, that the owner-operator owns or leases the equipment, and if the relationship ends, they can go and lease on with another motor carrier. The business entity has a substantial investment of capital in the business entity. Obviously, the point again to be made is they own the equipment, the tractor at a minimum, which is a very expensive piece of equipment. They're providing the labor, either themselves or another driver. They're providing certain insurance and the like. Next slide, please. The business entity owns or leases the capital goods, self-explanatory, gains the profits and losses of the business entity. The thing to emphasize here in an audit context is, some of your owner-operators are going to have higher margins than others, and that's based on the skill that they have in operating their own business. And that's an important point to make to the DOL auditor, that these folks are running a separate and independent business. They are at risk, and it's how well they manage that risk that's going to determine how much they make. The business entity has an option to make its services available to the general public or the business community on a continuing basis. We recommend, to the extent that you can, that the owner-operator lease allows for trip leasing. The business entity includes services rendered on a federal income tax schedule as independent business. Obviously, each owner-operator should be receiving a 1099 following a Schedule C. Next slide, please. The business entity is performing services pursuant to the written contract under the business entity's name. The idea here is you're going to have your owner-operator lease, and to the extent that you can have your owner-operators incorporate or become an LLC and enter into the lease with that entity, that's a good practice to have. When the services are being provided require a license or permit, the business entity is paying for that license or permit in the business entity's name. To the extent possible, the owner-operator is paying for any permits or licenses. Next slide, please. And if necessary, the business entity is hiring its own employees subject to applicable qualification requirements or federal or state laws. This is what we talked about before with, making sure that they can hire their own, drivers if it's a fleet. They can hire helpers as long, and it's okay for you as the motor carrier to say, well, they've got to meet the qualification requirements. Nothing wrong with that. It's when you start saying, well, I don't like John Smith as a driver, and you don't have a qualification reason related to that, or insurance reason related to that, that's where you have an issue. So we recommend the owner-operators lease being clear that they have the right to hire their own drivers subject to the qualification requirements, that they're responsible for the costs, and they have to pay the employees. And also, the last provision of the statute requires them to report, the owner-operators required to report wages of helpers or other drivers to the IRS. So place in your lease that they've got to do that, and there should be no objection to that. The motor carrier doesn't require that the business entity be represented as an employee of the commercial goods transportation contractor. We never recommend that the owner-operator is ever saying to anybody that they're an employee of you as a motor carrier. That's not a good practice. Next slide, please. And the business entity has the right to perform similar services for others on whatever basis and whatever it chooses. So again, the trip lease context, if we can put that in, that's a good thing to have. Just a kind of a little bit of a side point, the statute doesn't talk about non-competes and termination penalties. I would recommend that you evaluate the business case for these provisions in there. There has been some suggestion that New York will view those clauses as bearing on whether or not the entity is subject to destruction or cancellation, which is one of the prongs of the test. Other states have done that, so there are some states which, if you have a non-compete or a significant termination penalty in your lease, they will view that as a basis for reclassification. The IRS does not look favorably on those provisions when evaluating the FUTA status of the owner-operator. One of the questions the IRS will ask is there a penalty or are there restrictions on the owner-operator from providing services for somebody else after they leave? So I know some folks like to have those provisions in there. Just evaluate whether or not it's justified given the risk of reclassification. Next slide, please. Now, Connecticut is an interesting case because they've actually swung the other way. Connecticut passed a very draconian owner-operator reclassification interpretation over the last couple of years. They were swinging the way of Massachusetts, where basically it was almost impossible to operate a trucking business using the owner-operator model. And what Connecticut found is there were significant impact on the trucking economy. There was a significant lobby that went before the Connecticut legislature, and they actually just recently passed a statute in the last month and a half that is very favorable to the trucking industry and provides a very nice statutory exception to the definition of employment. So, if you can meet these next couple of factors as an owner-operator, you are considered independent under Connecticut law, and the law will go into effect October 1 of 13. It's been signed by the governor already. So you'll see the factors are relatively easy to establish. Number one, your gross vehicle weight in excess of 10,000 pounds, easy to meet. Number two, the owner-operator owns the motor vehicle or holds it under a bona fide lease arrangement. So the lease arrangement has to be a legitimate lease. It has to be commercially reasonable. If you are running a lease-to-own program in Connecticut, you do not qualify for the statutory exclusion. So that's just something to think about. That's carved right out of the statute. Next slide, please. The owner-operator's compensation is based on certain factors which may include but not be limited to mileage base rates, percentage of rates, hours of time expended, flat fees. So pretty generous standard there. The owner-operator may refuse to work without consequence. So that's something we've talked about in New Jersey, in the New Jersey context as well. Do they have to report at a certain time and take a load? Can they refuse it? Can they accept work from multiple contracting entities in compliance with the statutory limitations without consequence? So, as if you have in your lease agreement that they can trip lease provided they comply with DOT regs and they notify you, that would satisfy this this test. So this is a positive development. One other quick thing to note. There was a very recent Virginia federal court decision dealing with the Massachusetts reclassification statute, where basically the Virginia court said that Massachusetts had gone so far in regulating the owner-operator's relationship with the motor carrier on the workers' compensation side that they were preempted under the FAA. So basically federal law would preempt them from enforcing that statute. It was so much of an impact. So we are starting to see the pendulum switch back, which is a good thing. But there's a lot more work to be done before these legislatures. Next slide, please. Now, I know we're running a little bit short on time, but I want to just briefly go through, what's going to trigger an audit? Why are you going to be audited by either the state or the feds? So on the federal side, you have a situation where the owner-operator hasn't paid his unemployment taxes for a long time. And the IRS comes to him and says, you owe this assessment. And he says, well, actually, I was an employee the whole time. I don't want to pay those. There's a random federal audit. On the state, there's a random audit. What frequently happens is you have an owner-operator who files for unemployment. Well, once they do that, the state is going to start wondering, well, why hasn't there been unemployment contributions for this company? And they will start, the audit process. The worker files for workers' comp, and there's no coverage. The worker requests classification from the state or feds. Important to remember that the state and feds are communicating on an increasing basis. So the state talking to the IRS, the state talking to the federal DOL, and vice versa. Next slide, please. So looking in the audit context, what are they going to look at when they come? You're going to get a letter basically saying that in 2 or 3 weeks the auditor is going to come to your place of business and they're going to want to look at certain things. What are they going to look at? Well, federal and state tax returns, 1099s, W-2s, your cash ledger, your contract with your worker, so in your case the owner-operator leases, your general ledger, corporate minute books, invoices from owner-operators. So that's, a good practice is to have your owner-operators invoicing you in their entity name. Does the owner-operator have any stationery, business cards? So these are the types of things that the auditor is going to look at to evaluate what the relationship is. Next slide, please. Just to give you the process in New Jersey, which is very similar to the process in New York and Connecticut and elsewhere, the field auditor is going to come to your business to examine the records that we talked about and potentially other records. Remember, you're entitled to have counsel or another representative, your accountant, present at this meeting. And I would encourage you to do so. And it's not just an advertisement for my services, but what's a good idea is when you have the auditor in there, you want to shape the narrative. The auditor is going to go back and report to their supervisor, who's going to report to their supervisor. You help shape that narrative. You point out to the auditor why your folks are subject to the exclusion. And you provide evidence to back that up. So, you look at in New Jersey the 4 points for the exemption, and you show them why your owner-operators are subject to exemption from FUTA. You have that package ready for them. I know it's an adversary. Sometimes it can be seen as an adversarial process, but there's something to be said for making it a little bit easier on the auditor, giving them a nice package where they can go back to their supervisor and say, you know what, this one fits into the exemption, and here's why. These folks have a tremendous workload, like we all do these days, and if you can help get a file off their desk, sometimes that goes a long way. So what happens if the process, if we haven't shaped the narrative, quite as we want to? Well, what's going to happen is you're going to get an initial determination. The auditor will call you and say, look, we think these folks are employees. At that point, you usually can have the opportunity to have an informal telephone conference or meeting with that person's supervisor. If you can't resolve it that way, you're going to get a letter of determination from the NJDOL, which is going to say, you as the motor carrier are subject to these to unemployment tax for these folks. You've got to pay X. You've got these penalties. You have 30 days to challenge that assessment. So typically at that point you'll bring in counsel. Counsel will file the notice of challenge. It's important that you're early on in the process you're building a record. You want to get everything before the DOL in terms of why you're subject to that exclusion. Then what's going to happen is you'll typically have another informal opportunity inside the DOL organization. Then you'll have a formal hearing before the ALJ, the Administrative Law Judge. You also will have then the right to appeal to the Commissioner of the DOL. If all that fails, you can go to the Superior Court of New Jersey. But remember, what the Superior Court's going to look at is they're not going to look at it de novo. In other words, they're not going to look at the case new. They're going to look at, did the DOL evaluate the evidence that they had properly, or did they abuse their discretion? So it's important that the record is proper from the beginning, that all the evidence that you have is in from the beginning. Next slide, please. And again, we've talked about what are the penalties, contributions for unemployment, compensation, interest, workers' comp audit, fines, and then are you complying with the wage and hour laws in the state? Next slide, please. Now, you'll see for folks who were on the webinar previously that I gave, here are some suggestions that we have in dealing with reclassification issues. Your owner-operator is legally organized as a separate entity if you can get them to agree to that. You're requiring proof that the owner-operator is paying self-employment taxes or workers' comp if it's a fleet folks. You're analyzing your lease-to-own and financing arrangements in the context of the applicable state law that you're operating in. Next slide, please. Do you have non-competes? And then if there is, if your owner-operators are trip leasing and providing services for other folks, we'd like to get copies of those 1099s if we can, because that's a very easy way to provide evidence to the auditors that they're separate and independent from your business. Next slide, please. If they have business cards, that's great. Letterheads, great. The invoices should be submitted on their letterheads as well. Keep copies of that in the owner-operator's file so you have that ready in the event an audit comes in. In your owner-operator lease and how you're operating, make sure that you can document that the owner-operator has control over the means. So if you are giving, like example, if you're giving routing instructions, you want a disclaimer on there that they're only for informational purposes. You want to make sure that the owner-operator is bearing financial risks for losses due to their negligence. Again, that's usually handled in the owner-operator lease. Next slide, please. And to the extent possible, you have the owner-operator meaningfully negotiate rates with you as the motor carrier. Now, a lot of times that's not possible, but if you do have evidence of that in place, that's a good thing to show the auditor. Signage on vehicles, if you have disclaimer, if you have the possibility for disclaimer language, it's a good practice to have independent contractor under contract with JPK Trucking. Next slide, please. And now, as Obamacare is a hot topic, if only this was as simple as navigating this process. And you know, as a labor lawyer, I know this is a very difficult and overwhelming process, you know, to look at. You're just trying and focused on running your business. You're looking at you're operating in compliance with Fed law, so I know this is a frustrating thing to try and comply with. So if you have any questions or if I can be of help, you know, feel free. Craig Weindorf can always put you in touch with me. So thanks everybody for their time today.
And thank you very much, John, for that very interesting and informative presentation. We do have many questions that have come in. In the interest of time, we're going to aggregate those questions into just a couple quick inquiries. The first one I'll handle. Several people asked about the PowerPoint presentation. Anybody who would like a copy of the slides, please reach out to Craig. His phone number and email are on the screen. He can arrange for you to get the slides. And the second question that we'll handle, I'll pose to you, John. Do you see this trend continuing in other states across the U.S.?
Yeah, that's a great question, and unfortunately we do. Our office has been involved in organizing lobbying efforts throughout a lot of states, and even states that down south who you would envision would be a little bit more friendly to the industry. So it's important to monitor these developments. You know, as they go through the state legislature, get involved with the Motor Truck Association in the state that you're operating in. You know, keep in touch with you know, with Labor Council, and again, I would be happy to speak with folks about that. Unfortunately, given the economic situation and these unemployment funds being completely depleted, we're going to continue to see this attack until either there's a solution from the federal government or the federal courts. So definitely, you know, keep an eye on it.
Well, thanks again, John, and we'd like to thank all of you once again for attending this educational web seminar brought to you by Interstate Motor Carriers Capacity Agency, LLC. Anyone who has questions that weren't answered, or anybody who would like more information about Interstate or would like to meet with Interstate, please reach out to Craig, phone and email again on the screen. We thank you once again for attending. This web seminar is now ending. Have a great day.